Okay, this is the beginning of the home stretch. Good afternoon, everyone. I'm Bryan Castellani. I joined Genius in October. While I'm the newest person on the stage, I come with a long history across sports, media, and entertainment. At Disney, ESPN, and most recently, Warner Music. I'm excited to bring that experience to Genius Sports, particularly given the opportunity we have across the sports ecosystem, and in media and advertising in particular. And I'm fortunate to step into a finance team and a company with a strong track record of execution. But what really defines execution in a business like ours, what makes those numbers tell a story of consistency and growth? In the next few minutes, I will take you through our financial execution, our growth algorithm, new 2028 financial targets, and our capital allocation priorities. First, how have we done this? Our performance to date has been built on multiple sustainable revenue growth drivers, a largely fixed and predictable cost base, consistent margin expansion and cash flow growth, and the flexibility to invest for disciplined long-term growth. This isn't theoretical, it's in the numbers. So how have these principles translated into tangible results? Let's take a look. Since going public, group revenue growth has exceeded 20% each year, with a 26% CAGR from 2021 to 25. That growth, combined with cost discipline, has driven group adjusted EBITDA from break-even in 2021 to $136 million this year at a 21% margin. This has been powered by high-quality revenue in betting and media, both of which have more than doubled since our last Investor Day 4 years ago. The growth is geographically balanced as well. America's revenue has more than tripled. Rest of world has nearly doubled, and Europe is up over 60% and well above market growth in that time. In short, this business has come a long way since the last Investor Day, and we've built a consistent track record of financial execution. And based on everything you've heard today, the runway ahead of us is long. I feel we're just getting started, and that's why I'm excited to have joined Genius and to be here today. So what's fueling our next chapter of growth? The building blocks for betting and media should now be clear. We see a path for each of these products to contribute meaningfully to achieving 22% group revenue CAGR through 2028. You'll notice we're only providing betting and media revenue projections. Historically, growth and profitability have come from these two betting and media product groups, not from sports. So beginning in 2026, we will simplify our revenue reporting to align with how we manage the business. We will consolidate sports revenue into betting and media and report only those two segments. We will work closely with you, investors and analysts, to ensure a smooth transition, but wanted to highlight this today. Moving on to costs, our largest expenses are fixed and highly predictable. As you heard from Jack, our major rights agreements are secured for the next 4+ years. And the annual fees for those data rights are entirely fixed, with predefined annual increases set from the start of each contract. That gives us strong visibility into our rights fee cost base over the next 4 to 5 years. We have the personnel and overhead in place to support the next stage of growth, and therefore we do not expect material increases in operating expenses from here. That predictability has allowed us to demonstrate operating leverage every year since going public, and we see a clear path for that leverage to continue. The operating expenses shown on the slide reflect cash expenses, which align with our 30% group adjusted EBITDA margin target by 2028. This brings me to our new 2028 guidance. At our last Investor Day, we set a long-term target of 30% group adjusted EBITDA margin. Given the visibility over our model, we expect to reach that target in 2028 with $1.2 billion in group revenue and $365 million in group adjusted EBITDA. And while adjusted EBITDA is important, our long-term goal is to become a free cash flow compounding business. In 2028, we expect 60% conversion of adjusted EBITDA to free cash flow, which equates to approximately $220 million of annual cash flow. To be clear, our bridge from adjusted EBITDA to free cash flow, as illustrated on the slide, includes capitalized software development costs, CapEx, taxes, and net working capital. This shift towards cash generation is a core part of our story going forward. Because what's the ultimate measure of value creation? Cash generation that funds its own growth. With increasing cash generation, we want to also take this opportunity to reinforce our capital allocation priorities, which fall into three categories. First, organic reinvestment. We will continue investing in Genius IQ, both development and global distribution, because as you've heard throughout the day, it is strategically and financially critical to our future and our growth. Second, M&A. As the market moves towards single connected technology partners, we believe Genius is in the best position to combine sports data and technology. Our bar remains high. Any acquisition must be accretive to growth, margin, and our cash flow trajectory. Third, share repurchases. We've authorized a $100 million share repurchase, which we'll deploy opportunistically where it delivers the strongest ROI. The program may also be used to offset share count dilution, and we expect net share dilution to remain a low single-digit percentage per year going forward. Finally, everything we've outlined today reflects our base case assumptions. But we also see multiple avenues for upside, both through 2028 and beyond. For example, our high-margin self-serve advertising model has significant room to scale, and we have the talent and partnerships in place to accelerate that shift. As you heard from Josh, the Genius Media Network has real momentum and the potential to drive upside. Online sports betting could exceed our current assumptions, whether through regional expansion, in-play adoption, or adjacent opportunities like prediction markets, as you heard from Jack. Genius IQ could, as Matt highlighted, enable third parties to build applications on our platform, creating high-margin incremental revenue streams. And as we expand Genius IQ globally, we expect increasing data collection, efficiency, and auto-eventing, removing the manual efforts of statisticians and on-location personnel, which could further reduce costs and improve margins. So while we are confident in the guidance we provided today, the potential for upside is real. And under Mark's leadership, this company has delivered on every major financial commitment it has set. With that, I'll hand it back to Mark to share his closing thoughts. Thank you.